Well, I feel like we need to start this out. So if you did not see our last Jess and Sless, Steve had asked me this question. It's this like really difficult, thoughtful question. I was in the midst of a property rehab, and I gave this great like lecture about making business decisions and everything that's kind of going on. So if you're working on properties, what you should do. And part of this lecture is based around like, well, if you're looking at the finishes, you might need to make a business decision and choose the laminate countertop. Don't choose the quartz countertop. Steve, it was me. I did it. I chose the quartz countertop. I did it.
So walk me through.
I,
Walk me. You were pretty passionate about that response last time. So for our audience, what
yep.
changed and why?
So what changed? I feel I was aided and abetted. So my husband watched this recording. So we did it, and he was watching it, and he comes into the room and he goes, "But I really want the quartz countertop." And I said, "So do I." And so we kind of looked at the cost differential. For us, it was about a 12. So the math was, I will say this, the math was about $1,200 difference. It's a smaller house. And I do think, going back to it when you're looking at business decisions, this is not a large house. It's a 3-1. It's like 1,100 square feet. The kitchen is not huge. So it doesn't have an island. It wasn't going to be some massive slab of quartz or anything. So $1,200 is a difference. And we just did it. We do think it'll appraise better. So I will say that. I just think,
Yeah.
when it comes to, and we're in the process of refinancing it right now for a DSCR, a long-term debt service coverage ratio loan. I do think it's going to show better. It's currently showing for renters. I think it'll appraise better. So I could argue there is a business decision to it. But $1,200 on a project, it still adds up. So anyways, it's me though.
Yeah.
I'm the problem. I'm guilty, and I bought the quartz countertop. That's what's up.
And there's a Taylor Swift song all about you.
There is a Taylor Swift song. Love her. So
So
yeah,
before
so
we
that's
before we dive in, Jess, any long runs scheduled for this summer? Didn't you just came off a pretty long run? And when I say long run, by the way, for those who don't know, Jess, I'm not talking about 5 miles or 8 miles or even a marathon. I'm talking about hundreds of miles. This one runs, and she does it multiple times a year. So catch me up real quick before we dive into all things hard money and real
yeah.
estate. How's the running going?
So yeah. So the running's going well. I did a 50K over Memorial Day weekend. So 50K is about 31 miles. This one was closer to 32. Was I counting? Yes, I was counting. So I was counting way before I should have been counting, probably like at mile 17. It was awesome. It actually went incredibly well. I placed second for women, which was unexpected and pretty cool. Thank you. Thank you. It's fun to surprise yourself once in a while. And I will say this, it's funny. This is going to sound weird, but there's some similarities between running and real estate, in so much as day in and day out, you're doing the basics, you're doing the hard work. A lot of it's not very fun. All the training runs and stuff. There's days you don't want to go and you don't want to do it. There's definitely service calls or whatever related to real estate you don't want to do. But then suddenly you'll have a day like that. And in that case, I surprised myself by how well I did. I did suffer along the way. And I think they're good get checks. And similarly with real estate, sometimes you go to refinance or sell, and then suddenly you're like, it was all worth it. Um,
I think that's
that being
called a
said,
professional segue, Jess. Well
thank
done.
you. Thank you. Um, that being said, I had signed up for a much bigger race, and I think I'm going to back out. So yeah, it's a 70-mile race across Scotland. I've had,
That's all.
to Steve's point,
Just
I've done
70
some
miles.
big events, and they've taken a toll, and I just want to be really healthy to spend the summer with my family. We love being outside. That's a huge part of our summer plans. Excited out here out west. My son still has two weeks of school. I think your daughters are out, right?
They're done. Yep. Last day of school
Yeah.
was
Wow.
yesterday. Yeah.
Oh, okay. Yeah.
They're
So we're all
actually,
thinking
two of
summer.
them and my wife are actually midair right now, heading out your way, visiting my sister in law in Oregon and my new niece. So coming out to the
Oh,
West Coast for a few days. Yeah. As
I'm
I hold down,
excited.
hold down the fort here in Baltimore.
They'll have a fantastic time. It's beautiful out here. And so the place to be in the summer is outside. And I want to be able to do that. So I'll do some other races. I'm going to find some other stuff to do this summer, but maybe slightly less impactful in particular. I've got some knee issues, which surprises nobody. So, yeah. Well, there you go. It's me. I'm the
Running
problem.
70
Back to
miles at
you.
a time will do that to you.
Yeah. How about you? Anything for the summer?
I got an end of summer vacation planned, little Mexico retreat for a week. So looking forward to that. And
Ooh,
otherwise, a few day trips along the way and some pool time and, hanging with the kiddos and having a ball. So before you know
nice.
it, it's fall again and school starts and we're doing it all over again. So looking forward to the summer, looking forward to spending time with the girls and taking some trips. But yeah, nothing too crazy planned.
Nice.
And
Well,
I don't have
speaking
a professional segue from that back to
Well,
real estate.
I do.
Sorry.
Don't worry. This is why you have me. This is why it
I
goes
knew you
Jess
would.
before Sless. That's right. Yeah. So, so we're looking at summer, but we just came off spring. See what I just did there? So yeah, thank you. And I think, we had talked in, our last couple of Jess and Slesses about a slightly slower winter, the impact of weather, of course, which surprised nobody, that we expected things to start picking up in spring. And I think we did see that. And I just kind of be curious again, you had a operations and sales and all the things, but you live in that day to day. So coming off this spring, and especially I think we had a great May. What did you see? What did you experience? What kind of loans did we do?
Yeah, yeah. So sort of exactly how you just detailed it, right? So slow Q1, uh, but we've been here and done that before. This isn't our first rodeo, so we expect it to come rallying back in Q2, and we certainly have, and did last month. Had a great month of May, really, really strong, and we're seeing a lot of just fascinating deals, different types of deals. We're still here to fund the standard fix and flip and the buy and hold, and we're here for all that. But we're seeing more mixed use. We're seeing more multifamily. I think I mentioned this on last call too. There's trends here, more small balance commercial and uh, a wider geography, right? Not too wide. Our core is greater mid Atlantic, but we've also ventured slightly to the west a little bit, and we've entertained the right deal, which I think is important, the right deal
Mhm.
in the right geography. And that's a big part of our growth strategy is to look for again those right deals. If there's a great deal and it happens to be a little west than we would typically be accustomed to, we are entertaining those deals where we really couldn't sit here and say that this time last year, and probably couldn't sit here and say that this time maybe 6 or 7 months ago. So, and
Mhm.
we've found those deals, and we've funded some good deals, quality deals with quality borrowers and such, great assets in some other states. So that's the trend. We're looking upwards for the remainder of the spring and early into the summer. We're poised to have a really big month of June. We got a really stacked pipeline right now. So all in all, things are good. We're cautiously optimistic about
Mhm.
the greater environment, and there's some markets that we have our eye on that we want to tackle, and other markets that we want to reposition and maybe not do so much business in. But all in all, excited about what's to come here in June and the rest of the year.
Nice, nice. Do you think what you're seeing, and the strength of the, deals you're kind of describing, do you think they're following like larger, broader trends? To elaborate, we've seen, the Midwest is really hot. The Northeast has been doing incredibly well. We're all very familiar with some markets that have really seen softening. Obviously, parts of Texas, specifically Austin, San Antonio,
Sure.
that corridor. Parts of Florida, actually out my way, Seattle is having a really rough spring. So in terms of what you've seen kind of coming through the door and like volume and turnover, is that part of a larger kind of national trend or headline, you think?
Yeah, I mean, I think the trend that we've seen for quite a while now is the move away from the individual single rental property, right? Difficult to cash flow on
Mm,
those properties. Still great opportunities, but the right opportunities. We always talk about the right opportunity here. Those deals are tough to find. And when you do find them,
mhm,
the cash flow is difficult on those properties, and the margins have been compressed quite a bit. What we're
yes.
seeing a lot of is drug and alcohol rehab facilities. Those are interesting. A lot of those are state subsidized, and there's a pocket here in the local marketplace here in Baltimore that we're seeing good deals on those type of properties. Mixed use, right? Multiple tenant
Mhm,
properties. We're seeing those,
mhm,
and small balance commercial. Small balance meaning under $5 million could be a small strip center with a nail salon. And, we looked at one the other day that had a Starbucks and a Jersey Mike's as anchor tenants. So, really
mhm,
interesting. We're here to fund those deals. That's probably where we stop is in that, that small balance, right? That $5 million range or so. Um, but we're here for those. And then we also help on the exit of those as well. And again, we're lending short term, 6, 9, 12 months. So we're looking at those properties. We're happy to lend on those properties short term. And then we've also had a lot of success helping on the exit of those properties, working with local banks, working with other national mortgage companies, DSCR exits as well. We're doing quite a few of those right now. So we're not only here for the short-term hard money, but we're also finding a lot of success on the exit, which of course is great for us and our
Mhm.
investors on the short term.
Mhm. That's interesting. It's funny because you get to speak to kind of these broader pictures and trends and what you're seeing come in the door, and then I can give like tiny little anecdotes. To your point, it is compressed, so I am refinancing the quartz countertops, as it were, so that property and just the underwriting that we've gotten back from banks that we've worked with for years. Like we're incredibly well known to them, and they
Yeah,
have tightened it up. And they're discounting our rents. So if we have, in this case, a signed lease for $1,700 a month, they're like, that feels more like 1,500. And you're like, but why? The signed lease is 17. They're like, it's just how we're underwriting it these days, and you can kind of take it or leave it. So it's tough. It does make it tough on that single family, single income, or single revenue source, I guess is like a better term.
sure.
If that's kind of your method of investing as it is mine. So I definitely see the appeal of, small commercial with great anchor tenants and longer term
Yeah.
leases, mixed use and all of that. That's cool. It's
And
interesting.
that, and that, you mentioned underwriting. So we're adapting and we're changing the way that we underwrite files as well, particularly when it comes to valuations of properties, right? So that'll be my professional segue. Uh,
Oh, look at that.
a lot of deals come our way, and we have a saying here. You know the saying very well. All roads lead to Trius, right? So we
Mm-hmm.
get deals presented to us that they may have been shopped around a time or two. Most of the
Mm-hmm.
time, they come to us for speed, right? They need to close quickly. We are able to deploy capital quickly, fund quickly without the red tape and the BS, so to speak, of the banks.
Mm-hmm.
Oftentimes, the deals that come our way have valuations in the form of appraisals or BPOs. However, those reports have not been ordered by us. And that's a big
Mm-hmm.
red flag for us, right? So when we are evaluating a property, we may look at the appraisal as a point of reference, but we don't always use that appraised value. And we had multiple deals this past week where we looked at the value, we then vetted and verified the value and talked to local realtors on the ground in the marketplace. We'll get a BPO, a broker price opinion. We may get another appraisal, and we may have our valuations team look at it as well. What's fascinating now, and I guess you can call it a trend, is just the wide opinions of value, right? We had a property last week where there was a $3 million variance between the appraiser and the realtor who helped us with the BPO.
That's a
So then it
lot.
comes down to our
Yeah.
valuations team being on point and on their game and being to evaluate the property for the purpose of us lending on the deal. And I think that's important to
Mhm.
understand, right? Coming to either us for a short term hard money loan or a bigger bank for an exit, an appraisal, right, isn't always the holy grail. Um,
Mhm.
an appraisal oftentimes with a lender is the point of reference. And that's the point that I wanted to make is uh, as we talk about challenges in the marketplace and some markets being up and some markets being down, we're spending a lot of time focusing on what is the right value of that property, and are we lending in the right equity position based on what we feel the property is worth, not based on what the appraiser or the realtor think it's worth. We look at
Yeah.
appraisals all the time and we look at comps. We've identified comps that are, call it a quarter mile. Why the appraiser use comps that were a mile and a half away, right? Were
Right.
they trying to get to a certain number there? So it's just
Yeah.
fascinating, and I know you're very in tune with it, being the investor that you are. So thoughts on what you're seeing value wise, and just the difference of opinion with values nationwide.
Yeah, I mean, you hit on recency and relevancy, right? So there's always tension there between recency and relevancy because you might have something recent, but is it truly relevant? And it's funny that
Hmm.
can apply to both commercial and residential. I think it's dually applicable. But I think, talking about a broad kind of market trend or concern, obviously big commercial. So we're talking stuff that we never touch. It continues to be under incredible pressure because of interest rates. And I guess my question back to you is, as we underwrite some of these deals and you're looking at NOI, net operating income and everything. And you're also looking, and I know from our underwriting team really looks at how is the borrower going to be able to refinance out of us? What is the final disposition of this that gets them into success, be that long-term financing? How are, interest rates remain a headline? We can talk about them. But in terms of, kind of how that's playing into the underwriting and the whole picture, you guys kind of assuming things won't get any better is my guess. Are you kind of looking at that at all, or do you just figure everything's pretty stagnant? So if your appraisal or BPO is recent, that it's probably more meaningful because it's reflective of current interest rates and current market conditions.
Sure, sure. Yeah, no, a lot to unpack there. So
Sorry. Yeah, that was like
when
an
we're
18-part question.
I'm going to try to be
So
systematic with this. So
go.
when we are underwriting a deal, we're underwriting it to the exit because again, we lend directly on short-term hard money, 6, 9, 12-month loans. So how is the borrower exiting this property? Well, if it's a flip, okay, then we're concerned more with the value of the property and our equity position in that property.
Hmm.
What if the market adjusts by 10%? What if the market adjusts by 20% within the half a year or year that that borrower is going to be in our loan, right? So we have to take that into consideration. We call it what's
Hmm.
the fire sale number, right? What's our emergency break glass number that we know that our interest is safe, and more
Hmm.
importantly, our investors' interest in the loan is safe. On a refinance, where we believe that the borrower is going to put money into acquire the property, stabilize the property, exit the property via a long-term 30-year fixed refinance, we're underwriting to that exit.
Hmm.
Oftentimes, we will price it, shop it with local banks, right? To
Oh,
just make
okay.
sure
Hmm.
there's an
Yeah.
exit that there's an exit that's feasible here, right? So we have plenty of banking relationships, partnerships. We'll call up the bank down the street. Hey, here's what we're looking at on this deal. Is this deal doable? Borrower feels like they're going to be able to exit at, call it 75% and a 7% rate. What do you see on this? And so being in
Hmm.
business for as long as we have and developing the long-term relationship that we have on the banking side, we're able to leverage
Hmm.
those relationships and acquire the information that we need to determine, is there a viable exit? If it's a DSCR exit, what's the property going to cash flow at? Do they qualify for a DSCR? DSCR is very credit score driven. What's the
Yes.
borrower's credit score? And that's where credit comes into play. So we're always
Yeah.
looking at what is the exit and where can we be exposed? Where is our
Hmm.
exposure exactly? Where's our exposure throughout the progress of the loan? Right. So if it's
Hmm.
a purchase plus rehab, well, our exposure is really early on. When the demo
Right.
takes place, especially, right? So the value actually decreases for a little bit before it increases. So we're looking at
Right.
all of those things, and again, in the context of, are we safe? Are our investors safe? And are we approving a deal and setting our borrower up for success, not failure?
You unpacked that incredibly well. Kudos. That
Thank
was
you.
that was great. Um, Interesting. Yeah, that's all fun stuff. As Steve knows, I nerd out about all of it. So, um,
Our resident real estate nerd, yes.
yes, everybody has to have one. So I guess pivoting a little bit, and we've kind of like we sort of glanced towards larger headlines than we really kind of been talking about Trius. But larger headlines, there remain some big ones out there. Jobs report just came out and is quite strong, which again is going to point towards the Fed not being able to lower rates. So there's interest rates. There's some the housing bill actually passed and is going for signature from the president. And that really, I think, is an interesting headline. And that bill has a lot aimed at increasing supply of housing. There is, of course, the Berkshire Hathaway headline. They're going to become one of the largest, essentially, homeowners. I guess pick your headline. Do any of those strike you as the most interesting or most applicable to try it?
I mean, look, we have our eyes on all of them. Obviously, the Berkshire deal, it's interesting because again, there's been a lot of talk over these past few times that we've done this about the greater institutional capital market coming in
Mhm.
and buying up a lot of the residential homes in big bulks, in big batches, and sort of muscling out the independent individual investor who is our bread and butter. That's our core client. So we have our eye on that. Uh, Not all that concerned about any of those. Again, interest
Yeah,
rates. We've been through, this company's been in existence for 24 years, right? We've been
right,
through every market. We've been through '09, '08, and '09. We've been through it all. And we have a level of savvy and sophistication and incredible executive leadership that you and I are thinking 2 years ahead, 3 years ahead.
right,
And that's always important. So, you know, all of those things we're mindful of. You do a great job at bringing those to our attention, right? Because you're tracking it more so than most, certainly more than I am. My focus is more on the day to day and the here and the now. But I think that speaks to the strength of us as a company. Just we're able to know these things are out there, be cautious about them, underwrite conservatively, knowing all the market forces, but we also we don't ebb and flow as the market ebbs and flows.
right,
We sort of dictate our own pace, and I think that's really
right.
important.
I think they're actually encouraging. I mean, listen, housing remains a very strong topic within American culture. I mean, it's something people are thinking about. I think that's why you actually saw a bill get successfully through the House and
Yeah.
Senate. So I mean, that is its own statement, right? And
Yep.
I think the continued forecast for the need of housing. So when you see really large, privately held companies and investment companies continue to invest in American housing in the way they are, I think that tells you a lot, and it tells you we're in a good business to be in. So I find it all quite encouraging. And I also, it's in our last, I think, Jess and Sless, we were talking about something, and I said, well, if you zoom out, it's pretty interesting. And as it relates to interest rates, if you zoom out, my parents were paying in the 1980s, I want to say they had a 12 or 13%
Yeah.
interest in their
Yeah.
house when we bought it. I mean, so if you zoom out decades, Trius Lending Partners was not around in the early 1980s, but during that period, when those interest rates were at that rate, there was not a housing crash. Prices did not crash. And I think that what we'll continue to see is sort of like a normalized understanding that these rates are probably going to be pretty steady. And, people who are able to buy will continue to do so. And then I'm sure they'll have an eye towards hopefully refinancing in the future. But I don't think it's going to do something drastic to the market, you know?
Yeah, and I think exactly what you just said speaks to the long-term play of real estate. Real
Right.
estate is not, well, one, it's not for the faint of heart. You're going to have your ups and your downs, and you have to be prepared. You have to have an asset pool to fall back on for the down times. You know that better than anybody.
Hmm.
But long term, historically, if you invest in real estate and you let it ride, it will make you money, and it'll make you money and allow you to build generational wealth greater than almost any other asset tool. So, you know,
Yeah,
we certainly believe in that. We're here for the long
we
haul.
do.
We've seen it over the long run. I'm going into, I think I'm going into my 20 23rd, 24th year in the lending business. I lost track at this point.
Careful, you might
Um,
age yourself, Steve.
and we've seen it on, well, the hairline's going to age me more than
People are
my
going to be doing
comments.
math in public there. Mhm. You're like, I started real estate at the age of 12. No, I'm just kidding. Um,
Yeah, yeah. Oh, don't I wish? But look, we're big believers in real estate here. We're big believers in its ability to help our clients and our investors and ourselves build generational wealth, and it's a really powerful tool. We're here to help and to guide and to consult and to lead you along your way in in your real estate journey, whether that's investing in the loans that we make or whether that's borrowing to take down a deal with fast, flexible, reliable funding. We stand ready to help.
yeah, absolutely. I mean, I think that's about it. I just want to give out, we've talked a lot about the loans. I think that's what people are always really curious about. I know a lot of our investors actually listen to these. And so I just want to give a shout out to our investors. Just like we had a great spring quarter, we've had a great spring quarter in terms of fundraising, and it's really come from existing investors. So we're super grateful to them. I want to give a shout out, and it's able to help us grow and continue to propel the business. So Yeah.
Yeah, 1,000%. The investor is the lifeblood of our business here, and so we're always extremely grateful. And you do an incredible job of cultivating those long term relationships. And if you look at our core of investors, they're all long term relationships that have been
Yep.
grown and cultivated over time. And at this point, almost every new investor comes from a friend or family member or referral from an existing investor. You specifically just being on the forefront of the face of the investor here at Trius, kudos. I mean, you do a phenomenal
Oh,
job,
thank you.
and
Thank
our team does a phenomenal job as well. And so
Absolutely. Yep.
give them a quick shout out before we wrap up here. We have an
Yeah,
incredible team, a growing
absolutely.
team. We have some
Mhm.
summer interns coming
We
in
do.
to
It's
join us.
fun,
We have
some
one
energy. Yeah,
Madison is here, and she's doing marketing and PR. And then we have Emma and Lucas coming soon to help
yeah,
out for the summer. So exciting summer ahead. Great to talk to you,
100%.
Jess. Great to see
Likewise.
everybody. Tune in next time, and
Perfect.
thank you.
Thank y'all. Take care.